Hi, everyone, and welcome to our Lessors Risk webinar. My name is Jacob Cole. I'm the marketing coordinator here at CID. Today, Michelle Belden, our commercial underwriter, will be sharing her expertise on LROs and helping you take your game to the next level. Before I pass it off to her, I wanted to quickly go over the logistics of the webinar. As you can tell, you're all muted, but there is a chat feature, so you can type your questions in at any time, and we'll answer them throughout the webinar. Also, a short survey will pop up after the webinar, so you can help us improve these webinars for you. So we appreciate you taking the time to fill that out. And without further ado, I'll pass it off to Michelle.
Thank you, Jacob. Hi, everyone. I am Michelle. I'll be teaching our course today on LROs. Just want to go over a couple of things that we'll be hitting on in this webinar. So we're going to go over a definition of what an LRO is. I will say LRO throughout the webinar, most likely, Lessor's Risk. So that is the acronym for it. So I tend to use that because it's quicker. So we'll define the types of commercial buildings. We'll outline pretty much all the industry changes that I've been seeing, what type of coverages an LRO needs, and then we're going to do some underwriting examples through actual submissions that I've worked up, so you guys can kind of get an idea of how I quote and what information we're looking for. And then lastly, just the information that will be needed in order for me to offer you guys a quote. So first thing, let's define a lessor's risk. So that's going to be providing liability and or property coverage for the actual building owner. So the person who the property is deeded to. It's not going to cover the individual tenants that are inside the building. So that's a big thing that people kind of get confused on sometimes. They're like, I don't know who's responsible for what. So it's the building owner is responsible for insuring the structure, while the tenant is responsible for insuring the interior for their unit. So then for the tenant, that would generally be BPP coverage or possibly tenant improvements, but the actual building coverage itself goes for the building owner. So that's what you would need for a lessor's risk policy. As I said, it doesn't extend to the tenants occupying the building, and it's really important to find out who the building is deeded to, because that's who your named insured should be for the LRO policy. So I have an example that we'll go into later in the PowerPoint that talks about an owner-occupied building where they own the building and also occupy it. So we'll get a little bit more into those details, but it's an important thing to ask is who the building is deeded to. I'd definitely say that's probably named insured is one of the biggest things that people sometimes get tripped up on in an LRO situation. So knowing that information is extremely helpful. Okay, so we're going to go over just the different types of commercial buildings that are out there. So you got your professional buildings. Generally, those are going to be medical offices, professional offices, including like a lawyer, an architect, things with not necessarily a lot of foot traffic. Their clients are just coming in and out for business purposes. Those would be more of your professional type offices. Your industrial buildings, generally going to be your warehouses that are going to have either garage businesses in them, some light manufacturing. They all could also be like large warehouses, like an Amazon facility, things like that. So those are generally going to be your industrial type buildings. Then your retail strip malls and or just retail standalone buildings as well. So your mercantile businesses, things you would see on Main Street, restaurants, so clothing stores, little ins and outs of oddities. Those types of stores will be your retail strip malls. And then a mixed-use building. For me, I define a mixed-use building as where there's commercial and commercial businesses and or offices and residential units. Some people use the term as mixed-use building when they have, say, offices along with mercantile businesses. To me, that's not a mixed-use building. That's still just a commercial building because there's no residential exposure. So for me, the mixed-use building is really important in defining it as residential and commercial combined. And then I do want to say we can also look at insuring commercial condo units. So if somebody owns a unit within a commercial condo association, generally they're either professional type buildings or industrial buildings, and they rent their unit out, we can do that as well for the interior coverage as the building owner for that tenant, or for the owner, I should say. All right. Before we get into our examples, I do want to go over a bunch of industry changes. I'm sure you're all aware that the market is not fun right now. So you've got plenty of carriers who have pulled out of the market. They're no longer writing specific classes, or they've pulled out of the market altogether. I'm definitely seeing non-renewals from agents because tenants are no longer eligible with the carrier. So maybe that carrier is still writing LROs, but they don't want this specific type of tenant anymore. So they're having to get off the risk. I've also heard of certain carriers feel that they're oversaturated in certain areas, so specific zip codes. So they're getting off of that. So it doesn't necessarily mean there's anything wrong with the risk. It doesn't mean that they have losses um, or in a high wildfire or anything like that. It's just the carrier just feels that they have too much property coverage there, and in the event of a catastrophic loss, they're concerned about having to pay out all those claims. So I've definitely seen some of those. Brush and wildfire exposure, that's a big thing, especially in California, and it is branching out into other states. As we all know, I mean, that Texas just had that over a million acre wildfire, and then it's Oregon, Washington. They know about wildfires as well, so I definitely would expect to see more changes coming down for those areas that are definitely highly affected by them. I think California will be an example for some carriers on how they want to proceed with things that are in a high wildfire and brush area. I will say we are not a market for property coverage in risks that are in a high wildfire or brush area, but we could look at monoline GL or other coverages, but it's the property that we most likely want to be able to help you with. And then two, building age for some carriers. Some carriers only wanting to write things 20 or 30 years newer, regardless of updates. And then some of them are capping out at 50 years, so it kind of depends. We do have markets that don't have a building age requirement. So I've written and looked up things as early as the late 1800s. I get a lot of early 1900 things in San Francisco, so it's definitely something we can look at. On those older buildings, though, we would be looking for updates for our markets that can consider them, that don't have an age restriction. So we would be looking for updates on those. I'll go into a little bit more details on that in our actual examples. And now a new thing that's definitely popping up is crime scores. I'm having to run a crime score for every risk that I'm writing, and carriers are having guidelines on that. So if your crime score is too high, then that's another reason that I'm definitely seeing non-renewals or carriers declining a risk. And then on mixed use buildings, especially when it's on a non-admitted basis, there is generally a habitability exclusion. That is true in California, not necessarily in all states outside of California. However, some carriers are starting to add that on regardless of the state that the risk is located in. And then I just want to say that for my Colorado and Texas agents, it is much tougher for us to write in those areas compared to us writing in California, our home state. We just have more limited markets there, and our carriers tend to have lower TIVs that we can consider with them. So if you have a larger risk in those states, probably won't be an option for the property, but I can definitely look at monoline GL. And then I do want to just say, along with all these industry changes, as you're all seeing, and with so many non-renewals, the carriers that are still writing this business is heavily inundated. So it's taking much longer to get a quote these days. Before we would try to pride ourselves on getting something out within, 2 to 4 business days. It's really difficult to do that right now, which is how the market is. So as much lead time as you can provide is really appreciated, because sometimes if I can't quote it in-house, I have to get it rated up. Then I have to submit it to the carrier, and then the carriers at a minimum of a week turnaround. So then sometimes it could be up to 2 weeks before we get something back. So the more time you can give, the better. Sometimes I'm having to pass on things because they're just being brought to me the day before they're supposed to non-renew or expire, and I can't turn something around like that. We do have some options for instant quotes through USLI Mount Vernon. So we try to push that if it's an available class code that they can do, and you're looking for a quick quote. But again, the more lead time you can give, and then I've been telling some people, like, hey, I'm not going to be able to get to that before your expiration date or your non-renewal date. If you're okay with a lapse in coverage, I can still look at it. So kind of just been taking it. I've been getting a lot of things that have had lapses in coverage because people just haven't been able to find replacement coverage for their risks that they're bringing that are getting non-renewed. Okay, so let's talk about coverages. What coverages are important for a lessor's risk? So building coverage is the main coverage, so that's what we're doing to ensure the structure. Sometimes we can have BPP for lessor's risk as long as it's owned by the building owner. If it's BPP of the tenant, we would not cover that. That would need to go on the tenant's policy. So sometimes an example of BPP I might see is maybe they have like tables and chairs outside. They have a little bench or something like that, or maybe there's a fence that's not connected to the building. Then that's something we could look at as BPP. Business income is a really important coverage in addition to the building coverage. That's providing the loss of rents coverage. So in case, there was a loss and the tenant in their building has to close down and then their tenant isn't able to pay them rent, they're losing income as the building owner. So that's an important coverage. I will say with business income, we generally don't have markets that can offer ALS, actual loss sustained. So we need an actual limit available for business income. So an annual figure is what we're looking for there. So sometimes I'll get it and an Accord 140 will just say ALS, but then there's no number. So that would be a common thing I go back on asking for. So we do maybe have a few carriers that can offer it, but for the most part, most of our carriers are looking for an actual limit to be input for that. And then also, if your policy qualifies for special form replacement costs, you can be eligible for building ordinance coverages. So we have coverages A, B, and C available. A would be included, and then B and C would be a limit chosen by the insured or you as the agent helping them pick that out. Generally, I see anywhere from 10 to 15 or 20% of the building limit for those ones. And B and C can either be combined or individual limits for those. So something else to keep in mind. Equipment breakdown. We can add equipment breakdown on anything. Most of our carriers automatically include it, so we can add that on there. If they don't want equipment breakdown, we can definitely remove it to save them, a little bit here and there. And then most carriers have their own property enhancement endorsement that will have, sometimes that one will have like a throw on of a water damage. So the limits will vary by carrier for those property enhancement endorsements. If they are looking for a water damage, like a limit, and it's something we can schedule on, then definitely include that on your 140, and we can look at adding that coverage on as well. And then your general liability. Some people think that as an LRO, they're only concerned about insuring the building and don't think that they necessarily need GL coverage as the building owner because their tenant carries GL. If a loss were to occur, like a trip and fall or something, say in the parking lot, as the person who decides to sue could end up suing both the building owner and the tenant. So it is important that the tenant carries GL as well. And then with the GL, we can also look at adding on hired and non-owned auto if it's needed. It's definitely recommended, for those little errands they may run, maybe depositing rent checks to the bank, things like that. So it's definitely an important coverage to think about adding on. Again, there will be an additional cost, so some people won't take it because they're looking, from a price perspective, and will cut out what they don't think is necessary. All right, so we're going to get into our examples now. So this first example is about a quote-unquote owner-occupied LRO. So in this instance, we have an auto repair shop who occupies this building, but the owner who owns the building also runs the auto repair business. So when you have these situations, an important question to ask the insured: who owns the building and who operates the business that's occupying the building? So in this instance, the building owner owns their building in their individual name. Let's just call him John Smith. But then he has his corporation for his auto business, Auto Repair Inc. So they are two separate entities, even though they are owned, even though the corporation is also owned by John Smith. Since they are two separate entities, the carriers would view that as an LRO exposure. Now, if it was Auto Repair Inc. owned the building and occupied it, then the building coverage would need to go on Auto Repair Inc.'s policy because they are the building owner and the occupant. In this instance, there is a difference, so we have to separate out those exposures. So if you have those ones, it's definitely an important question to answer. A lot of people don't know. So I always say a good way to ask them is, who is the property deeded to? Because that's who the named insured would be on the building. And then if that named insured doesn't match the name of the business that's occupying it, then you'll know right away that they are two different entities and we need to separate that exposure. So for this example, we're just going to kind of go through things that I would be seeing when I'm reviewing accords and why and how I would quote something. So for this instance, they're looking for GL, building coverage, and business income. So we're looking for a package. So it's a single-story building, joisted masonry, built in 1965. Year built is important to know because, like we talked about earlier, there are carriers that have certain age restrictions. So, if I saw 1965, I might look up my list of carriers and go, already know that 5 of them are out because this building is too old for them. So then I would go on to my next step, and I just process of elimination to determine what markets I can quote with. So for this one, with it being built in 1965, it looks like they only have partial updates. So they have only the roof and the wiring have been updated. They haven't updated their plumbing, and there's no heating present, so we don't have to worry about a heating system being updated. But then we also have original galvanized plumbing. With most carriers, galvanized plumbing is either prohibited, or if we can't offer a quote, it's going to be on basic ACV. So had this building been completely updated, roof, wiring, and plumbing, since the heating's not present, we won't take that into consideration. With the galvanized, even with the updates, so from that perspective, it sounds like they would qualify for special form. But because of the galvanized plumbing, this makes them only qualify for basic ACV, or some carriers will pass on the risk altogether because they don't like that plumbing. Most carriers are looking for copper plumbing or PVC. The galvanized, it's just not something that they're either wanting or that they're comfortable with offering the special form on. So they'll offer basic ACV. So in this instance, I would be looking at quoting this on a basic ACV basis. So if I get accords that have, when I get I always check the limit. So if the limit's based on a replacement cost value, I'll go back to you and let you know, hey, I can only do ACV on this one. I need a revised limit because the limit's too high. At say, let's just say for this example, $250 a square foot is what the original limit came in at for replacement costs. Well, none of my carriers are going to offer $250 a square foot for ACV. So then we would need to lower the limit to get more in line with an ACV value. Ways to do that would be to run a cost estimator. There are ones out there that do the ACV value. Some people take just like $125, $150 a square foot for the ACV. I've definitely been seeing that. Definitely your ACV limits have increased over the years, just with the cost of goods these days. So the same with your replacement cost. It's definitely increasing. So, before people used to say $150 a square foot was in line for a special form replacement cost value, but it's not necessarily the case these days with the cost of goods. And then some other things to talk about that I look at and ask on, that these are questions that would be on like a supplemental, noting that there's fire extinguishers present, but they don't have any smoke detectors. For us, on all of our quotes, fire extinguishers and smoke detectors are required. A lot of people think smoke detectors are only needed because in residential buildings, but our carriers require them. All of them, it's a life safety measure. It helps, ensure that if there is a fire, you're alerting the people that are in that building and can hopefully get out safely. So it is an important thing to have. So it's definitely something that we notice a lot on loss control. Same thing with fire extinguishers. A lot of times they'll have fire extinguishers present, but they haven't been serviced in the past few years. So we require that fire extinguishers are serviced on an annual basis. It's really easy to get that done. We have somebody that comes into our office once a year and he services our 3 fire extinguishers. He's in and out in 10 minutes, and we don't even know he's here half the time. So it is definitely an easy thing to do. And some people will just buy brand new ones, which is fine, but then the next year they need to be serviced. So those are important life safety measures to have in place. All right. So for our next example, we're going to talk about an LRO with some vacancies. I'm not seeing too many that have had a lot of vacancies. So the vacancies can determine on whether this would qualify as an LRO or if it would need to be rated as a vacant. So it is important to find out the percentage of vacancies in it. Some carriers cap out at 30% vacancies, some cap out at 50. So it kind of just depends on the carrier and how much vacancy they will accept. So for this example, we're going to use a retail strip mall that has mercantile tenants, restaurant tenants, and then a couple tenants that they're looking to lease out their units for. So we're going to have this be a two buildings in this instance, built in 2014. So we're looking pretty good there from the age. We're only 10 years old at this point, so most carriers are capping out at 20 or 30 years for where they're maybe starting to get a little iffy. So this one would be great from that perspective. I'm good there. Special form replacement costs, I can already tell that we should be able to offer that. No problem there. So they have 15% vacancy, well within most of my carriers' guidelines, so I don't see any issues from that perspective. So it's a good thing. And, when you find out once those vacancies gets filled, it's always important to let us know as underwriters who has taken over those units, because each carrier has guidelines on which type of tenants that they will accept. So let's just say, for example, maybe a cannabis tenant moves in. Well, the carrier that it's with, that could become an issue if they don't accept cannabis tenants. So it is important to, let us know what type of tenants are moving in and for those vacancies, just to ensure that coverage is still eligible. We don't want it to be found out that, there's this tenant in there now and we didn't know about it and the carrier wasn't aware, and then they just have to issue, either a non-renewal notice or decide to get off of it midterm. So it is important to, relay that information. An important thing as a building owner, you should be collecting COIs from your tenants, and making sure that they are naming you as additional insured on your policy. All of my carriers require this to be in place. So I've had to decline risks because building owners don't require their tenants to name them as AI, and or collect COI. So it is very important that they do that. It is something that will be checked, during an inspection. They will ask that question. It is a question that's asked on our supplemental. So it is an important thing for them to have in place. So for this one, from a life safety measures standpoint, the buildings are 100% sprinklered. There is a fire alarm, and they have fire extinguishers in place, and they have the necessary maintenance contracts. So like I was saying with the fire extinguishers, about having the person come in and check them once a year, the same thing with your fire alarm. It's no different than if you had an elevator. Those are all things that you would need to be having checked. Same thing with sprinklers, having those checked on an annual basis, to ensure that they're in working order. And to also ensure that they don't have any defects with them. People will have their sprinkler test done, and then they'll find out that one of the sprinkler heads isn't working at all, which then in the event of a fire does not help them, because it won't go off and do what it's supposed to do. So it is important to have those checked out on an annual basis to make sure that they are working in proper order. Same thing with restaurant tenants. They need to have their hoods inspected. They need to have their deep fryers, everything like that. That would be a necessary maintenance contract. That's what our carriers are looking for there to be in place. So that is a common loss control item that I see is their contracts are too old. They haven't been checked in over a year. So those are important things to have in place. And again, it's helping not only the building owner but the tenant as well. This is helping us try to prevent losses from occurring. All right. Okay, a statement of values. So in that last example, I said that there was two buildings. So when there's multiple buildings or an insured owns multiple locations, we're looking for a breakdown of the buildings. I wouldn't be able to offer blanket coverage, so I would be looking for a breakdown of the buildings or the locations if they own multiple locations. So generally it's breaking it down by the number of units if it's mixed use. So we would have your number of units would be your residential figure of it, and then your square footage, the commercial square footage. And then we would need the total square footage. It also breaks down your property limits. So again, your building coverage, your business income, that's all getting broken down. So we have it by the buildings. And then it's also important if they have any other like detached components. So maybe a garage, there's a fence, maybe there's a little storage building on the property that they're needing coverage for. So breaking all of that information down to ensure that we're offering property coverage on everything that needs to be included. Because if like I get a cord and it's just a building limit and the business income, that's all I'm going to be rating for. And then I'll come back and be like, oh, there's this, there's this little building or there's a trash enclosure. There's no coverage on there. Well, you didn't provide a limit. So then it's important to provide and break down all the coverages that you are looking for. Okay, so our last example will be about a mixed use LRO. So again, my definition of mixed use being apartment and commercial together. So in this instance, we've got mercantile businesses on the bottom and apartment units on the top couple floors. So it's a three-story building built in 1929. So like I said, those older buildings we definitely can look at. But it was fully gutted and remodeled in 2015 and brought up to code. However, there are still some carriers out there that will see that original year built as 1929 and just say no. So unless the building was completely demolished and rebuilt in 2015, then they would look at it. But if it was only taken down to the studs and then gutted and remodeled from there, then the original year built would still be 1925, making it ineligible with certain carriers just right off the bat because of the age. Again, important things to have in the building: fire extinguishers, smoke detectors. For residential units too, or in commercial units, if there are any gas appliances, heater, stove, anything like that, we would also be looking for carbon monoxide detectors to be present. It's an important thing to have as well. Not something that you need just for residential. Again, too, it's a life safety measure, so it's helping the people who are inside that building get out in the event of an emergency. Okay, so getting a quote. What do I need from you guys? I need an Accord 125, 126, and 140. Please be sure to include the building square footage. I can't tell you how many times I get Accords for an LRO that don't have the building square footage on there. That is what the GL is rated on, so that is important information for us to provide you guys with terms. A list of the tenants occupying the building. Again, too, I get a lot of Accord 125s that say Lessor's risk or commercial building leased out, but then I don't know who it's leased out to. So again, I need to know that information because the type of tenants can dictate what markets I can go to. And two, like I was speaking about earlier, the annual rents is really important for the business income coverage for them. Supplementals, we can work off of most carrier supplementals. We do have our own. Depending on the tenant, I don't necessarily always need a supplemental, but especially if there's like a restaurant tenant in there, I'm definitely looking for a supplemental because we want to confirm that those the hoods and things are like that are in correct proper order and that they're cleaning them on a regular basis and taking the necessary steps for that. So definitely we'll see that. And like I said, any carriers supplementals, we can pretty much work off anybody's. If we issue a quote and a carrier has a specific supplemental, we will include that with our quote for you guys to complete if they want to bind coverage. If they have multiple tenants, a rent roll, or a tenant listing, I don't really care how it's given as long as I have a list of the tenants occupying the building. I will say about rent rolls, sometimes, especially in commercial ones, generally they're in the name of the business, but sometimes they will be in the name of the individual who's occupying that. So I would need to know what that individual's business operations are. So that is an important thing, to make sure you find out from the building owner if they give you a rent roll that only has individual names on there. Now, there could be individual names on there because they are residential tenants, and obviously you don't need to know their operations because I would know their residential units. But for the commercial ones, we definitely need to know what the business operations are. A statement of values, as we talked about, for breaking down the buildings or multiple locations. So that's always helpful. Some people won't provide one and they'll just fill out an Accord 140 for each building and or location. So that's totally fine. Building valuation, like I was talking about earlier, calculating the building. I always double check what limits you guys are looking for. So I take the building limit, divide it by the square foot to get the cost per square foot. These days I've been seeing anywhere from I would say for a replacement cost basis, probably like $185 up to $350. Generally, once we get over $350, my markets might have some qualms about it and come back to us and be like, So if you have that building valuation that can support having that high of a limit, then we can definitely look at offering that with the carrier. And these days, it's really important that you provide loss runs. It's really hard. We can try and look at quoting subject to clean loss history, but these days most carriers are asking for loss runs regardless. So it is important to get those from your insureds if you can, especially if if you're the agent on the account already, then it should be pretty easy for you to gather them. But if you're a new agent to that client, then having them request it, it's really important. So, and if there have been losses, it's really important that you provide loss details. So I need to know what happened, have the damages been repaired, and then what actions they took to try and help prevent this from happening again. I have to sell this to the carrier. So, I have some authority on losses, but then once certain losses can get larger and they exceed my authority, I have to submit it to the carrier and I have to try to sell it to them. So the more details you can provide in that instance, the better, because it really helps to try to, help what carriers we can go to and get them to be able to offer us a term. So if we can, explain to them what happened and say, hey, like sometimes they're a fluke, and carriers will accept that even if it's on the larger side. And then some carriers are just like, they have losses, no thank you. So it is really important for us to have that narrative so we can talk to these people. Now, target premiums these days, it's kind of hard with everything being non-renewed. So, sometimes people have something in mind, and given the current market, it doesn't necessarily mean that that's where we're going to be. But target premiums or expiring premiums, they are helpful in comparison. Sometimes we have wiggle room with our carriers still. So, we may not get down to what they were paying on an expiring basis, but, maybe it's only $1,000 or $2,000 more than instead of double more than what they'll take. So that is something that is helpful for me. I do want to say one more thing on the loss history. The overall loss history is definitely taken into consideration. So maybe they had a property loss, but they haven't had any GL losses. Some carriers will still decline to offer the GL because of the overall loss history. So that's why it's really important to give all that information about the losses so I can try and best sell it and get somebody to bite and take the risk for us. All right. I see we have a question about student housing. We are not a market for student housing. So nothing, student housing, no sororities, fraternities, anything like that. It's just not something I have a market for. All right. Some additional information you guys should think of while you're quoting or while you're gathering information for me to quote a risk for you guys. Again, asking the building owner if there are any vacancies. Talked about who the building is deeded to is really important. The type of plumbing, like we talked about with the galvanized plumbing. So knowing the type of plumbing can dictate what markets I can go to or what coverages I can offer. So it's really important to ask that question. The type of electrical panels and the type of wiring present. This is a really big one right now. So, every carrier's got their own guidelines when it comes to this. But generally, if there's fuses, aluminum wiring, knob and tube wiring, Zensco panels, Federal Pacific, Square D, Murray, so many different kinds of panels out there. They can be prohibited with certain carriers. So it is really important knowing what type of panels are present. Some people don't know. If you can take a picture of the panel, especially on the inside, it generally will tell you the brand, though sometimes I'll have to say they're so old that the sticker is either worn off or it's so faded you can't read it anymore. So it can be hard, but it's really important knowing those type of panels because it will matter what carriers we can go to, because some carriers will just decline altogether because of that panel is present. Some carriers will accept them. So it is a question that I ask all the time. And then two, it's something that comes back on loss control a ton. I've written a risk, we'll get the inspection back, and they'll be like, there's Federal Pacific panels there. So then to remain eligible on the risk, the panels either need to be replaced or the carrier is going to get off the risk. And then trying to have to find a replacement market who's okay with it, taking those type of panels isn't necessarily always easy. So I try to ask as many questions up front as possible. I want to make this as smooth as possible for all of us throughout the whole policy term. So not only quoting it, binding it, but the inspection and things like that. So the more information we can gather, the better. So I know sometimes I probably irritate people because I ask a lot of questions, but it is really helpful for all of us. So we're not in a pickle. Finding out that they have these panels, and then it might be a costly job, so they're not able to update them, and then we're then like, okay, so what are we going to do? We're going to try to get them replaced. We're going to try to find a replacement coverage for them. Or are they just going to have to go without coverage until they can get the project done? Things like that. So it's really important to ask these questions and try to gather as much information as possible. And then I did talk about how I run and determine the building limits. Just one other thing on that, do not base your limit off of the market value. That is not what your building replacement cost limit should be based off of. So that's just something that I see sometimes, and it doesn't make a lot of sense because sometimes your market value might come out to like $1,000 a square foot. And then I do want to mention about AIs, if there are AIs needed. So generally for an LRO, you're going to be looking at your AI would be a mortgagee or and a loss payee. So getting that information is really important. Half the time I'll get a policy bound, and then like within a month I'll be like, I don't see the mortgagee listed on here. Well, there was no mortgagee listed on the accords, or you didn't provide one in your bind request, so I wouldn't know to have added one on. So if you can get that information up front, or at least at time of bind, that's great. I can make sure it's added on there. And then management companies, depending on the carrier, some carriers will include them as an AI. Other times they're automatically included because of the status based on who is insured in the policy form. So that varies. And then one other thing I would note is triple net leases. So where the building owner requires the tenant to carry the building coverage, we are not really a market for triple net leases. So in that instance, it really depends on if it's something we can consider. Is it one tenant? Is it multiple tenants? How they're splitting it out? So triple net leases are definitely something to be on the lookout for. All right, and then I see we have a question about mobile home parks. We can consider mobile home parks. It's not necessarily our most competitive class, but I don't necessarily think that it's that competitive right now in the market in general. As far as property coverage for mobile home parks go, we can do like if there's like an actual mobile home unit that is for like the manager that lives on the premise, we can do property coverage for that, but we would not be able to offer property coverage for all the units within a mobile home park that are being rented out. There are restrictions on the rental percentage that I can consider in mobile home parks.
All right. Thank you, Michelle. So if anyone has any questions that weren't answered during the webinar, now is the time to chat them in so we can answer them before we sign off. And after we do sign off and you fill out our 3-question survey, I encourage you all to browse our website. We have tons of tools for you to use, you and your office, including marketing materials, proposal templates, fillable applications, online quoting options, and a ton of recorded webinars on different lines of business and coverages. So don't hesitate to reach out to Michelle if you have any questions on LROs that we didn't answer today. And you can start sending us your submissions to the submissions email you see on screen. So that'll do it for today's webinar. Thank you everyone for joining us, and we look forward to doing business with you. Have a great day.